Deloitte reported that geopolitical tensions and capital efficiency regulation are some of the external factors pushing $1 billion companies in Asia Pacific to urgently rebalance their portfolio. To discuss this, we have Jiak See Ng from Deloitte. Jiak See, how do geopolitical tensions and such regulatory changes influence the portfolio rebalancing of companies?
Obviously, we have a lot of uncertainties in the global economy. We also see political tensions and constantly evolving regulatory requirements. So businesses will have to learn how to navigate geopolitical tensions in order to grow and to minimize the impact on their cost of operations. This means that some may need to reposition their investments in the marketplace, the supply chains, and also to look for new trade partners in the Asia Pacific region. In fact, geoeconomic fracturing, to me, it presents significant opportunities for companies. For example, diversifying supply chain into emerging markets like Vietnam and Indonesia can offer substantial growth potential. Companies should also look to form new partnerships and alliances to mitigate them from adverse market forces. And also, they have to continue to drive growth in these emerging markets. So all of these are only drivers that the influence the companies decide where to allocate capital, but there are also other drivers. So according to our recent client surveys report, we just released, we had 250 executives across all industries in all the key markets in Asia Pacific. We know that there are at least 3 other drivers that influence capital allocation decisions. This is as to where they should balance their investments. One is the need to comply with sustainability and climate regulations. And the second driver is the pressure from their shareholders' activists to ensure that there's a continuous look at the shareholders' return. But more importantly, the third driver is really due to technology disruptions, be it AI, Gen AI, or quantum computing. So this will impact the company's strategic priorities. And to help them to get a competitive edge in the market, they got to continue to look at where to recycle their capital. So let me share with you a data point based on our survey. Close to 60% of the executives we surveyed are now assessing their portfolio performance at least twice a year, which is up from 46% from just 2 years ago. So the key takeaway is really that there's an urgent need now for the companies to frequently review the portfolio holdings. So whether it's business units or their assets, to rebalance them, look for growth opportunities, and also to divest the assets that no longer fit.
So, to enhance deal values and portfolio assessments, how can companies integrate ESG considerations?
I like that question because we also see from the survey that the companies that have a strong value story that includes an ESG strategy are 6 times more likely to receive higher deal value. Isn't that amazing? But what is interesting to me is that the survey found that 95% of the executives admitted that they tried to divest one of their portfolio companies in the last 12 to 18 months. However, they were not able to sell and they had to abandon the sales. That just shows that in order to be able to successfully divest a business at the right deal value, the companies for sales must be well prepared way in advance before it is launched in the market for sale. It is really important for the management to be well prepared to be able to articulate a compelling value story, to integrate in their story the pathway to net zero, to decarb, and also they must have a separation strategy in order to diversify the asset and the business from the bigger organizations. So it is important also for the companies to identify the right pool of investors and buyers.
Now, taking everything that you've just mentioned into consideration, how can Asia Pacific companies adopt an always on portfolio management approach to align their assets?
This is a very good question. Companies should always adopt an always on mindset for portfolio reviews. It means that to dedicate resources to review the portfolio performances regularly and comprehensively. There should be a board level oversight to ensure that each of the portfolio companies fit in well with the business strategic direction. So there must be an alignment to the company's purpose, the vision, and the strategic priorities of the companies. Each businesses must be able to enhance the value of the whole organizations, bringing synergies to other business components. So for the asset that are identified as non-core or have no strategic fit, then they should be able to have a compelling stories to incorporate ESG and digital transformation strategy and also to build a good track record so that we can maximize the value on sales. So in our survey, we learned that every 4 out of 5 executives say that they are expecting to make at least 2 or more of the divestments in the next 12 months. And 99% say that it may not be outright sales. That means it may not be just 100% stake sales, but could be through a joint venture or forming an alliances or bringing a private equity investors in. So in conclusions, each businesses must take actions to ensure that they continually looking at growth opportunities to create value, not just for the shareholders, but to contribute towards the community by doing good for the society.
Thank you so much for sharing your insights and for joining us today, Jiak See.
Thank you for having me with you today.
Once again, that is Jiak See Ng, and Deloitte Asia Pacific Strategy, Risk, and Transactions Leader. For more news, visit AsianBusinessReview.com.